G'day guys, James here from the Atlas Wealth Group. Just wanted to thank you all for tuning in each episode. If you like the podcast, give us a like, rating and share with your friends, just so we can educate and inform more Australians. Be well and see you on the next episode. G'day expats, ladies and gentlemen. Thanks for joining us today on another episode. As always, joined with my co-host, Managing Director for Atlas Mortgages, Jeremy Harper. G'day Jeremy, how you going, mate?
Great, James. Welcome, everyone. Thanks for tuning in again. We always love to have expats wanting to have the finger on the pulse with what's going on. So today we're talking about the RBA's decision, so quite fresh, just recently on Tuesday. So do you want to jump in and what were some of the highlights that stuck out for you in the meeting or the minutes that came out?
Yeah, well, I mean, the main one, we got a pause. We finally saw the RBA hit the pause button. And I think it got a lot of people excited because it really means we are getting very close to sort of the end of that tightening cycle. I mean, I think the way he delivered the minutes, and even when he was at the press conference yesterday, Philip Lowe, it was rather neutral, always data-driven, as we know. Also mentioned that a lot of the interest rate decisions that have already been made, the full effect of those hasn't really been felt just yet on households. So they are mindful of that, which is really good to see. And I mean, conversely, when we look at, our neighbours, the RBNZ, New Zealand, they just went up again by 0.50%. So they're still really trying to curb down inflation. But when we look at the RBA, it was good to see a pause. I think he also did make mention that there could definitely be some further tightening. But overall, it was a really good neutral response. The market loved it. It does mean we are nearing that point again. We're almost there. We're almost sort of over the hill and at that peak, which is really, really good to see. What were your thoughts on his minutes?
Yeah, definitely. I mean, obviously, he talks about inflation and that getting back to that target range. And everyone, that's pretty well known, that 2 to 3%. But
yeah,
I think the closing comments are pretty important. So talking about how, as you said, expect some further tightening and may be needed. So it's very sort of loose, not locking himself into either way.
that's it.
And then talking about that they will be assessing the data, but not just about focusing on the inflation, but also the state of the global economy and trends in household spending and the labour market. And I think the household spending is probably getting a bit more traction with what they're reviewing. Yep. And if you look at, and we can put a link to this in the show notes, but if you look at the savings ratio, which he always referenced, particularly coming out of COVID, when that savings ratio for households was incredibly high because everyone was at home, awash money, not saving. If you look at the way it's trending, it's quickly going to sort of negative territory. And I think they're acutely aware that currently not all the current interest rises previously have sort of filtered through. So that's still to play out. I mean, if you look at the February decision, that starts to impact people's mortgages repayments this month.
That's right.
It does take a few months. And then obviously you've got the March decision as well.
Yeah.
And then you've got the fixed mortgages that are coming up this year. So I know you mentioned there's some substantial, I think about 17% of the fixed loans are coming up in June to expire. And that's, I think that's one of my loans as well. And so that naturally will change people's disposable income or after their commitments. So that's going to have a slowing down impact by itself just from those loans rolling off the next 12 months.
That's right. And I mean, obviously very data driven. And one other sort of important report that comes out today is that financial stability assessment report that the RBA does on a semi-annual basis. So some of the good data that comes out of that report for our listeners is looking at the change in household spending, how much everyone's somewhat putting into their offset accounts now. One comment that they've already made is that people are putting a lot less in their offset accounts compared to a few months ago because naturally they're really starting to feel the pinch of the cost of living pressures and their rising interest rates. And that sort of dials in very well with what you just said. The savings ratio is coming down and, people aren't putting as much in the offsets.
Yes. And so just on rates, obviously the variable rate has maintained. They've held it for this month. But on the fixed side, a couple of weeks ago we're talking about this on a previous episode where what happened with the bond markets in the US banks, that changed the pricing globally. So in terms of fixed rates, we started to see that all changing the pricing. And actually, in the start of this year, the pricing on the fixed loans was increasing substantially. But now that's all the banks in the last couple of weeks, even today, been getting notifications, banks are cutting their fixed pricing by anywhere between 30 and 60 points, which is really interesting because I was seeing that the 1 year fix was more expensive than the 3 year fix. Now that's changed. So it's gone back to where the 3 year fix is more expensive than the 1 year fix. But if you look at some of the pricing, and I'll give you an example because I think that's pretty interesting in terms of where banks are sitting on their pricing. So if we look at an owner-occupied variable rate, roughly sitting around, say, anywhere between 5.25%, 5.5% is sort of where the variable's sitting. But if we look at some of the fixed loans after some of these pricing changes, you've got the 3 year priced at 5.29. So that's basically priced exactly the same as today's variable price.
That's right.
So there's not such a premium. Maybe 6 months ago, that 5.29 was priced at 6% or north of 6%. So that's really come back down. So it's very interesting to see that.
Yeah, that's right. And I mean, sort of what we referenced on one of our previous episodes was the ASX and that expectation curve. So where they think as, I guess, a general market tractor. And that has actually already updated as of yesterday. I think we're talking about, August 2024, September 2024, it was about 3.1, 3.2. We can see that that's already dropped right now. When we look at April next year, the market's pricing in the RBA's cash rate will be about 3.24%. So showing that there is going to be maybe a cut or two in the next 12 months, not necessarily going to play out because at the end of the day, it's just trying to, with that forward pricing, make a bit of a prediction there. But it also shows that we're pretty much there. We pretty much have peaked. The RBA, they are mindful of, rate decisions, not having that flow on back. And with that being said, and what we'll talk about on another episode very soon is that fixed rate mortgage cliff. You've got a very large cohort of Australians, Aussie households, which have really been insulated from all these rate rises. They haven't actually felt the same cost of living pressure as most others because they've been on this juicy fixed rate mortgage. You said it yourself before, yours comes off in June, where you're paying, probably a mortgage with a 2 in front of it. And that's going to bounce out to, as you said, 5.5%. So a big change there, a big increase. Some of the other interesting data that Philip Lowe talked about yesterday at the National Press Conference was the arrears. So what they look at and they carefully monitor it is the 30 and 90-day arrears, as well as the above 90-day arrears. And they get a lot of this data from, the banks, as well as APRA being the main regulator. And what's really interesting to see is the arrears rates right now, they aren't the lowest that they've been, but they are very close to being the lowest that they've been. And I think that's really interesting because we haven't seen interest rates go up this quickly for a very long time, yet arrears are still very low. And they even said, it wouldn't surprise us if it does rise, but it could even rise quite a bit and we still wouldn't be too concerned. So I think that's really interesting that's the RBA's viewpoint and assessment right now of, I suppose, the arrears mortgage market. Got to remember, even with businesses run much leaner balance sheets these days, where they're not sort of, I suppose, loaded up with so much credit and debt compared to GFC days, which is really, really good. We sort of got a much different type of business structure and framework now. I thought it was also interesting sort of what their central forecast was for inflation. So they reckon that by mid-2025, inflation should have tracked back down to about 3%. So we're a little while off that, obviously another 1 to 2 years, but that's really promising that's where they think it'll be because, that means things will ideally be a little bit more cheaper when we look at sort of the present value of money. But I really want to know whether we'll get another interest rate decision and what the US Federal Reserve will do as well, because we know that they're moderating now as well. We might even see a pause from the next US FOMC meeting. Very interesting times because we are almost there. And I mean, what's this going to do to the property market as well? When we see this fixed rate mortgage cliff start to come off, it's anyone's guess at the moment, because a lot of even real estate agents, they've obviously got a job to do, but when you look at economists, they're saying it's going to be obviously a slow burn coming off the fixed rate mortgages, which it is. We'll look at that on another episode. But what's also going to happen to the property market? Is there going to be some areas which will remain insulated and really still strong prices, good auction clearance rates? Or is it a case where, everywhere's you're really going to feel it later in the year because of everyone coming off the mortgage, the cheap money, and not being able to afford those repayments? I really wonder what banks will look at doing to look after those clients as well that can't actually afford their mortgages, and we've coined it before, those mortgage prisoners. Remember the assessment rate when these guys were getting a fixed rate mortgage at 2%. What was it? It was 5%, was it? Or was it 6% or 7%? Or
5.5%.
Yep.
So it's not at the moment, if they're getting close to that on the variable rate, it's not going to be too much of a change. It's going to be, what is that household change in their consumption? So living expenses, did they go out and get a car loan, which a lot of people do post-settlement? Have they taken on any other debt? That's where it can eat into that repayment difference.
That's right. Credit cards can sometimes be kryptonite for mortgage assessments as well, even if you have no outstanding limit. You could have a credit card worth 50 grand, but you've got nothing on it, but it doesn't matter. The banks don't like that. They usually want you to shrink it down or get rid of it. Anyway, we'll see what comes over the next couple of weeks into the next rate decision. I reckon next month, because the RBA will get another flood of data, especially from the March quarter, which will be really good up-to-date figures. I think market expectations would be at least probably 0.25%, and that could be it. We could really, really be there, which means, if you're going to be looking at investing in property, I would say in the next 12 months, well, there's probably not going to be too much of a difference on that price between now and 6 to 12 months. We've got to remember, whenever you're buying property, you're going to own that property for the next probably 5, 10, 15 years. So the differential between now and 6 months' time, probably not much in the grand scheme of things.
Yeah, I'm not sure if they want to be raising just before they deliver the federal budget.
Yeah,
how that would go down. So we'll see. Normally they sort of hold off between elections and the federal budget. So he'll be a brave man.
Yeah, that's right. It'll be a very brave man, and be interested to see what comes through that budget, especially with that recent update on that super and the 3 million balance, which is really grinds your gears. I know we caught that on one episode. In the meantime, guys, thanks for tuning in for today's episode. Look out for our next episode regarding that mortgage cliff. Thanks, Jeremy.
Thanks, guys.